Good morning and welcome to the Killik podcast for Friday the 18th of December. So this week we finally moved off zero in terms of interest rates in the US economy, and Janet Yellen emphasized the word gradual in terms of the trajectory of interest rates going forward. So inflation will be the key data point that they use to map interest rates in the future. And the market is expecting the next rate hike to be in June because they don't think core inflation will move that quickly in the first half of 2016. Here we've got a chart called the dot plot. So we've got in blue the Fed funds expectations, the Fed dots, and in red we've got the euro-dollar futures. So this is what the Federal Reserve expects in terms of the interest rate trajectory. This is what the market expects. So at the moment you've got a divergence here where the market is expecting the Fed to normalize or bring down the expectation of rates going up. So that's going to be a key bearing on sector performance in 2016, whether the market starts to up the expectations in terms of the pace of interest rate rises or the Fed brings it down. So that's what we're going to be watching quite closely throughout next year. The inflation trajectory will also affect the breadth of the market, and that's been a really key issue for this year. So we've got extreme divergence between high growth stocks, known as a classification called FANG, which is Facebook, Amazon, Netflix, and Google, against the rest of the market, the S&P 500 here. So the market is sort of wondering whether we get some sort of normalization and some of these sort of high-flying stocks come off their very high multiples and the market starts to pick up. So that'll be determined by what is going on with inflation and what's going on in the cost of capital. So cost of capital starts rising a bit quicker. It'll make it harder for this group of stocks. Inflation starts to rise and feed through into the market more aggressively, and that'll be good for the more value components of the S&P, so we'll get some sort of closing. So again, inflation is extremely important there. Our feeling is that inflation will grow gently in the right places that support the consumer, and the prospect of higher rates will start to support the banks. But overall, the cost of capital will stay low in absolute terms, which means these stocks can continue to perform pretty well. In a slow week, Star Wars was big news this week. So the box office, Star Wars hit the box office, and the initial first week numbers were extremely strong. So estimates are for 750 million in the US box office, 1.5 billion international box office, around 30 million video units, and merchandising of $5.5 billion per year. So this all equates to around 9% of EPS for Walt Disney in 2016. Clearly the stocks had a good run, and we've had some recent volatility over concern over ESPN subscriber numbers. But we feel that there's upside still in the stock from here. Star Wars can surprise on the upside. Shanghai theme park has got a lot of transparency over the trading there. I think that could surprise on the upside. And the generally stronger consumer should flow through into Star Wars in our view. We also had SolarCity Analyst Day early in the week, and this one is worth mentioning just because the share price has been so incredibly volatile. So we've gone from what was around $65 to down to $25, and we're now back up at around $57, all in the space of a couple of months. So it's been a bit of a rocky ride, and that's been due to perceived financing concerns around solar stocks in general, which we don't think apply to SolarCity. So that sort of concern is starting to subside, which has helped the price come off the bottom. We're also seeing within SolarCity no growth is really priced in beyond 2017, when the tax credit comes down from 30 to 10%. This week we got some sort of early indication that there's increased probability of that tax decrease slowing, and actually we're getting tax credits beyond 2016-17, and the movement to 10% is at a slower pace. So SolarCity continues to be the lead player in US distributed generation. They're growing at about 40% per year through to 2020. They've got 32% market share and therefore have those scale advantages. And they haven't really explored international expansion. So, we think that offers a really interesting growth path for the business that's not really priced in. So next week we've got a very light diary. So the key stock is obviously Nike there. Just looking at Nike, their Q2 numbers, they go in there with very high expectations. They've got a 90% beat record in terms of earnings numbers. So I think the market is still expecting EPS acceleration. The international business has been very strong, particularly China, which is higher margin. Continue to see improvement in sales mix as more sales go through the internet channel, offering higher gross margins. But you've also got this slight offset because we've had a very warm winter, and there are some increased competition issues in things like basketball at the high end in the States. So we'll obviously expect those numbers to be pretty solid, and we'll see that next week. So this is the last podcast of 2015, so it just leaves me to wish you happy Christmas and a restful holiday season. Thanks very much. Bye.